appreciate, Ben, you're joining us today. Ben Druffel is a relationship manager with Northwest Farm Credit, and he's going to be really giving you a great perspective as a lender on how you can prepare to buy land and some of the programs and things that Northwest Farm Credit is able to offer beginning farmer ranchers, and what they really like to see prospective buyers come to them with in terms of information and kind of their background due diligence. So with that, Ben, I'm going to go ahead and stop sharing my screen, and you can share your screen at any time, and I'd love to have you give a more in-depth introduction.
Perfect. Let's see if I can get this figured out here. So. Okay, can you see that?
Not yet.
Oh, here we go.
Oh, now it's coming. Okay.
Perfect. So yeah, I guess
you're just not in slide presentation mode though on what we see.
Oh, perfect. Okay. Can you hear me all right?
We can hear you, and now we can see your first slide. So thank you.
Perfect.
Awesome.
So yeah, that was great information. Everything I heard. This sounds like a really beneficial class for you guys, kind of getting into looking for some farm ground or just any sort of ag ground in general, I guess. So I worked for Farm Credit as a relationship manager, and basically, I guess I kind of am the middleman between a customer and our credit teams. When the customer has a loan inquiry, I'm kind of the guy that walks them through it, and I guess it's just kind of the middle ground for a customer and Farm Credit. But I'm just going to go over kind of a high level what we kind of look at when we have an inquiry walk in the door. Feel free to stop me at any time if you have any questions. It might be fairly quick. Hopefully I don't go too quick, but yeah, so here's some of my contact information. Feel free to, if you guys are ever down the road and find a place you like, feel free to give us a call, either me or kind of depends on what region you're in, but we have relationship managers all the way across to Idaho, Washington, Oregon, and Montana. So kind of depends on where you are. Every relationship manager is kind of going to know their region the best, but if it's anything around here, feel free to give me a call. Otherwise, each one of those dots is where we have a branch. We're based out of Spokane, Washington. Is where our headquarters is. We're actually co-op owned. So when you have a loan with us, you're actually a customer owner, customer member, and we have some neat things we can do with that. We pay back a patronage percentage of every loan amount every year, so we can essentially be more competitive than conventional banks with our co-op structure and the Farm Credit system, I guess, backing us. We have around 700 employees. Yeah, that's a little bit about us. This is a few things that we deal with on a daily basis. Real estate financing is probably, I don't know if it's our largest thing that we do, but we do a lot of it. Operating lines is definitely the thing that takes the most time. But in terms of our portfolio, I'm not sure if it's larger than a real estate or not. But our operating lines, we have to service those every year. So if a customer's got a changing operation every year, we're reviewing it and seeing how things are going. So they definitely take some time. Equipment financing, we do a small amount of that. We have a sister company, AgDirect. If you guys are getting going and need kind of a small equipment loan, that's probably who we'll turn you towards, is Ag Direct. They can usually get stuff done quicker than us, and a lot of times they're cheaper, not always, but we actually have crop insurance. I don't handle anything with crop insurance, but we do have that sector. And then we have country home loans. So any home, and I'm not sure who provides the guidelines, but in a rural area, we can lend on. So yeah, that's a little bit about us. Here's our locations again. AgVision. This is kind of our program that we have a lot of our beginning farmers enroll in. So you can see the parameters here: 35 years or younger, 10 years of farm experience or less, gross revenues less than 350,000. So if I remember correctly, I think most of you would fit into that criteria. And this AgVision program just gives us a few more underwriting criteria that we can kind of have some wiggle room on.
So I just want to jump in, Ben.
Sure.
I believe that you do not have to meet all three of those criteria. Is that
Nope,
correct?
that's correct. So you just have to meet one of these three in order to be enrolled in the AgVision program. And I think once you're in it, it's either 10 years or, if you don't meet any of them any longer, then you get you graduate from it. But it's you can be enrolled in it for up to 10 years. So yeah, thanks for that clarification. That's a good one. So here's just a few things that we can do with it. Some fee waivers. So an appraisal fee. When you guys get serious about buying ground, we'll have to do an appraisal on it. That'll be one of the first things we kind of look into, and we'll go into more details why that's so important later. Appraisals can be fairly cheap, and they can be fairly expensive. Kind of depends on what we're looking at. Loan origination fees, we have the ability to waive those as well. So every loan that we write on real estate is going to have a 1% loan fee, which is something you guys might want to jot down. Sometimes it's not a huge fee, but if you get up there in some of these larger loans, that 1% fee can really add up, and it can actually make a bit of a difference. So with this AgVision program, us as relationship managers have a little more flexibility on waiving those fees. We can be more competitive with an interest rate. That's one that it's definitely not someplace that that's kind of the one that everyone wants to jump to. AgVision, oh, we're going to have a better rate. That's not necessarily one we like to start at. That is one that I guess we can kind of jump through some hurdles and work on, but I would say that's not one that we use all the time. These education and technology benefits, these are kind of I think they've done these for a few years now, but they're really kind of gaining popularity with our customers that are enrolled in this. So basically we'll just give you $750 for any technology that you're bringing to your operation. So if you want to buy like a drone, or if you want to buy a computer to do your book work on, anything that would kind of fit into that category, Farm Credit will pay for up to $750. And I'm pretty sure on that number. Jessica Harper, I should say, actually put most of these slides together. So a lot of this stuff she did. She's our AgVision specialist up in Spokane. And she wasn't able to jump on tonight, but a lot of this information comes from her. So another $750 for travel reimbursements, and educational commodity workshops. So like your ag extension, putting on growers meetings and stuff like that for each region. Some of those costs you you can have farm credit paying for. We have a lot of BMC events. I think it's Business Management Center is what it actually stands for, the acronym. Farm Credit puts those on, and a lot of times they'll put you up in a hotel and stuff like that. If there's any of those that you guys are interested in, if you're enrolled in this product. Yeah, so this is a $1,000 credit towards succession planning. So if you have, an existing family entity that you're trying to pass down from generation to generation, then we do have some succession planning workshops that they've been putting on that you'll have credit towards as well. You do have to be a customer to get these, so so the program eligibility, this is we kind of went over this a little bit before. If you meet one of those 3 criteria that we spoke about previously, then you'd have to meet these as well. But a lot of these, are just any loan with us as well. I mean, these aren't necessarily specific to AgVision. A couple of them are, but provide adequate collateral for the loan. That's really any loan, have a cash flow budget that projects repayment ability for the loan. That's AgVision, but that's really any loan as well. A minimum 650 credit score. I think that is a little bit lower for the AgVision program, but I think our conventional loans are right in that range. Financial information and business plan indicates operation will show positive financial progress. So that's basically just saying, you have historical financial information and you're going to be able to basically sustain your sources of income. Sometimes we'll see, people inquiring for a loan, but it looks great, for the next couple of years, say they have some sort of, note receivable or something from selling another entity. But as soon as that kicks off the balance sheet, then, we will have to show that, that loan's sustainable, I guess, for the life of the loan. Have sufficient ag education, business and work experience. That's not as strict as the FSA. It sounds like a few of you have worked with the FSA before, and they require, I'm not sure how many years of, actively farming. We don't require that. We just like to see, you've been around it a little bit, you have a good, background, and you have a decent business plan, and, kind of a decent idea going forward. That's all that is. And then the last one, basically, you can't have been foreclosed on within the last 7 years. So that's fairly straightforward. Any questions so far?
We haven't seen any come in. If anybody does have questions, if you just put them in the chat, then Mackenzie and I can make sure that Ben gets those to answer.
Perfect. Yeah, I don't know if I can see the chat, but.
No, we'll read them to you, Ben.
Okay, perfect. Okay, so here's another couple, I guess AgVision again. Again, you wouldn't necessarily have to be enrolled in AgVision to I guess try to do one of these partnering loan options. But I guess AgVision probably, it might work a little bit better if you are in AgVision, but again, it's not a requirement. So probably our biggest one that we work with is the FSA. Sometimes when we have loans that are technically out of our lending parameters, collateral position is weak, maybe say the margins are a lot tighter than we'd like to see. Later on in this presentation, I'll kind of show you what some of the parameters are that we're looking at. Basically, if any of these parameters are higher risk or or tighter tolerance than we would like to see, we can put an FSA guarantee on it. And basically what that does is that mitigates our risk. So if a loan does get foreclosed on, something goes bad, and the FSA would basically cover 90% of the losses we would incur from that. We do have uh, loan to value requirements, but it kind of I don't know. People always forget how expensive it is to, I guess, it rarely happens, but when we do have to foreclose on a property, that can add up. The expenses can get very expensive. So a lot of times we're actually losing money on it by the time we exit the relationship. And so this FSA guarantee can mitigate that risk. And allow us to kind of stretch out a little farther. The FSA down payment program, this is one I wouldn't mind, you guys kind of really taking a look at. If you guys are ever, thinking about purchasing a property, it seems to work great. I've used it countless times, and every time I've used it, it's just been a great program for, both parties. It's great for us, it's great for the FSA, and it's great for you guys. Basically what it allows us to do, it brings our our capital requirement way down to 5%. Usually we're requiring 30% down on just an in-house financing, where Farm Credit's just going to finance it. We would need 30% down. When we partner with the FSA, this program allows us to limit that to 5%. The FSA has a loan for 45% of the loan amount, and we finance the remaining 50%. The FSA's term is usually 20 years, and they allow us to bump ours up to a 30-year. So that can kind of limit your debt payments annually. The farther you term it out, the smaller your payment's going to be. Usually we can only go out to 25 years, but again, when we partner with the FSA, it takes a little risk out of it. So we're willing to stretch out a little more, and we'll go out to a 30-year. So that's a great program. I definitely jot that one down. And it's something we could visit when you guys get serious about something. So the Washington State Aggie Bond Program, I've never written a loan this way. It's very effective. You can get very low rates on it. I'm not sure if it reduces your down payment requirements, but it's another option out there that we could visit if you're buying ground in Washington State. Again, I've never used it myself, but I've been around relationship managers that have, and they've spoke pretty highly of it. So it's just another tool out there if you're in Washington State. So.
Ben, we do have a question that has come in, and the question is, do you have any experience with combining any of these options with VA loans?
Again, I don't. I know we do like to help the veterans out as much as we can, and I think there is some additional lending parameters that are specific to them, but we have never had a partnering loan with the VA. I don't want to say it's not something we would do, not possible, but I've never been involved with that. And a lot of times the organization is fairly specific who we'll do partner loans with. If you just have, basically we only do them with a handful of people. But again, I don't want to say we wouldn't or we haven't. I just am not sure on that. I can follow up with on that if if you'd like. So.
Yeah, that would be great. I'm wondering if maybe the relationship officers in Spokane or perhaps down in that would service Mountain Home would have more
Okay,
experience with that
sure.
because of
Yeah,
the
and Jessica
is
might
there.
know too.
Sure.
She seems to be kind of on top of all that stuff. So I can I'll follow up with her and shoot you an email on what I hear. So
Okay, that'll be great, and then I'll share that. Oh,
perfect.
and for
Oh,
those of you, Ben is located in Lewiston, Idaho, so just about 35 miles south of Moscow, so in the Panhandle. That's great. Thank you.
perfect. Any more for now, or doing
Nope,
good?
we're good for now.
Perfect. So this is another program we have for kind of our young and beginning farmers. It's our RateWise program. And this is something that you guys can get involved with right now. You don't have to be a customer to enroll in our RateWise program. And it does it looks really good when we have an inquiry come, walk in the door or give us a call and they're enrolled in this already. It just, I mean, it's not necessarily a huge thing, but it just kind of, it's just one of those things where it's just kind of nice to see, it just shows that the person's been, thinking about this for a while and, kind of been planning on it, I guess. But anyhow, it basically just rewards you for being involved in, you know, education and ag and, kind of encourages young people to go to workshops, um, conferences, industry events, and basically the more you attend, the more of those events you attend, then Farm Credit will give you credit for each one you go to, and can build up enough points to lower your rate down the road. And we actually have some younger guys that have really been diligent about kind of staying on top of these things, and they have lower rates than some of our older customers that probably are more financially strong. And I guess because of this RateWise program, we've allowed them to get the rate kind of down there where it's pretty cheap. So it's kind of a neat program, something to take a look at someday. So Jessica had this in here. These are kind of your, I guess, your main lenders that like to work with ag. When you guys kind of get the ball rolling, maybe some of you have already, I'm not sure, but a lot of commercial banks are fairly picky and specific on what kind of ground they like to finance. There is some more risk in, I don't know if there's more risk, but it's just it's different financing ag than a lot of commercial businesses. There's just a lot more, I guess, unknowns. There's just a huge variety of different things that people can get into, and some of these commercial banks aren't as excited on financing ag as I guess we would be, or the FSA. Some community banks are getting into it, and then you have your private investors, family, friends, and I guess that's probably going to be your main people that will venture into financing for ag. Every once in a while, we'll see seller financing. If you're seeing a seller work through, it seems like, if it's the seller, this works great. A lot of times, if the seller is going through like a real estate agent, we rarely see the seller want to finance. If you can have a relationship with someone that might sell down the road, this is a great tool. It works out really well for both parties, and I would encourage that if you can kind of rig that up. where a seller's willing to finance you. But anyhow, I guess I could kind of go into that if we want to, but otherwise I'll just kind of leave it at that. So, so these are a few of the things that we will initially ask for a customer when they apply for a loan. First thing's going to be a balance sheet. I'm not sure if you guys have worked through one of those yet. Basically just verification of your assets and liabilities, your inventory, equipment, all that stuff. Basically, you're just a snapshot of your current financial position. And then 3 years tax returns. So your tax returns are going to show us, basically your proven earnings, and kind of, what kind of repayment we can get out of a customer, and how large of a loan I guess we can write. And then this next one is kind of a tough one, and it's something I would encourage, when you guys are working through these things, I would encourage you to work with, industry experts, someone in the region that's been, if it's a true projection where you're venturing into something that you've never done before, they can be really challenging to get an accurate look, of what a profit and loss cash flow is going to look like for the upcoming year. So a lot of times we will encourage people to, reach out to an industry expert in that region. A lot of times we'll help customers a lot with these things if we, feel comfortable doing so. Where if you're getting into a niche market, we're probably not going to have. We might have seen it before, but we're probably not going to have the expertise to be, really dialing one of these in for you. So these are, I guess, a key thing that we like to really focus in on, especially for new startups and, expansions and stuff like that. So a business plan, not required, but it's awesome when we see one. Just kind of gives us an idea that, customers thought it through, has a good idea of what they want to do, where they want to go with it. If we don't see one, it's not the end of the world, but I mean, we probably will ask, I guess, a lot more questions if we don't see one, to try to better understand, I guess, what your goals would be with a piece of property or a business venture like that. So purchase sale agreement, fairly straightforward. When you're done negotiating, then the seller will sign purchase sale, the buyer will sign the purchase sale, and it's basically it can be a month, can be 2 months. Basically just gives you a kind of a security and gives you a little time to acquire financing without the seller coming back in and saying, we want to change this and want to change that. They're locked into what's on that, and you're locked into what's on that as well, to a degree. If you can't come through, then it just kind of falls through, but kind of the terms and conditions are kind of set in place at that point. Entity documents, this would be if you have, if you're not a sole proprietor, if you have a corporation or an LLC, we would want to make sure that those any entity documents are up to date, that the entity is currently active with the state they're located in, and just make sure that everything's good to go there. Any questions on these things?
We have a question that came in, and you might be getting to that. The question is, how does lending work with Northwest Farm Credit for land with versus without a house?
Okay. If you could remind me of that here in a couple slides, if I haven't gone over it already, but yeah, probably in a couple slides, I might go over it a little more in detail, but not quite like that, but I will go over that here in a second.
Okay, great.
So these 5 C's of credit are basically how we make every lending decision. We analyze each one of these things, I guess, as an application comes in. And I'm just going to go over briefly and probably kind of quick, just kind of some of the high points of each one of these things. Some are, they tell us that none are more important than others, but there are some that we spend a little more time on, I guess. So I'll just run through those real quick. Character. This is it is a big one. It's a hard one for us to really. I mean, this is the only one that we don't have, I guess, real hard information to just say, here's what it is. It's laid out in front of us. Either have it or you don't. This is the only C that we don't have that. We kind of have to make a judgment call, I guess. Management experience. Maybe you have it, maybe you don't. It's not the end of the world. That is one thing we'll look into. Experience in the industry. Same with management experience. It's nice to see, at least you've been around it. You have some sort of background in it. If you don't, again, not the end of the world, but it would, it's nice to see even a class like this. You could throw that out there and say, I've run through some of the stuff. Stuff like that. It's not necessarily set in stone, but these are a few things that we're going to look at. The business plan, we kind of went over that already. Three-legged stool. It's kind of how we'll, I guess, look at every operation. I guess we kind of take a look into these 3 things. So production, is it sustainable? Is it, profitable? Stuff like that. Processing, just like you guys were talking about earlier, if you're going to raise cattle, you got to be able to, process those cows and take them to market. So is there infrastructure for those things around? For example, we had a handful of customers over in Montana that were just gung-ho for hemp. It was kind of the, cutting edge. Guys wanted to get into it early before the market was saturated. Things looked good. Production looked good. Processing, they figured they could kind of process it themselves, bale it or do something. But there was no infrastructure set up anywhere. I mean, there's some set up in Washington, but no infrastructure like they needed to market that product. So most of the guys, most of our customers that grew hemp over there, it was just a complete loss, just a waste, because one of those 3 legs, wasn't set up quite yet, or wasn't, where it needed to be. So those are just some things, kind of to take note of, and that's kind of what we're going to look at. Credit history. We'll go over that here in a little bit. Maybe next slide. Credit report is really, I don't know if you guys have gone over these or not, but they're really kind of becoming more and more important all the time. It seems like, 10 years ago, a credit report was not, they weren't taking it into a huge consideration as much as they are now. A lot of our lending decisions, especially on our smaller loans, are going to be a lot of our decision will be based off the credit score. For any loan smaller than 500,000, we actually run it through a program. Once we kind of check all the boxes off and say, yeah, it looks all right, we run it through this program that pulls your credit and kind of gives us a risk rating, is what they call it. And probably the majority of that report is based off your credit score. Not necessarily just the number, but kind of what's been going on with it. So it's just something to be aware of. Definitely something to spend some time on, making sure, you're doing the best that you can, and, progressing that score and making, not, I guess, having it drop on you. If it is dropping on you, there probably is some sort of, problem that you want to, I guess, look into. And I'm not an expert on credit scores, but there are a few things that, kind of are simple things that kind of stand out. If you're using too much of your credit limit, that dings your score. We see that a lot with customers, looking at an operating line year over year, and every year it drops a couple of points, and the customer's kind of like, I make my payments all on time. I don't know what's going on. Well, if you only have a $5,000 credit limit and you have a credit card balance of $2,500 at any time during the month, even if you pay it off right away, it's going to ding you for having more than a third of your credit limit fulfilled at any time throughout the month. So just something to kind of be aware of. This
Okay,
must be some. Oh, go ahead.
we do have a question. One of our participants checked their credit score, and their history was 13 years, but it only classified as fair because the average length of the credit history was 25 years. Do you have any tips for that? Does the credit score change with?
Yeah, that's a tough one. I wouldn't know what to tell you there. There are different, I guess, credit reporting agencies that will take, different factors more seriously than others. But I mean, yeah, it shouldn't take 25 years to build up credit. But fair credit, I guess, I'm not sure. Here's some ranges that Jessica put together. But if you have, even 680 or above, really it shouldn't affect things too majorly. We like to see 700 above, but I don't know how to answer that really. It's a tough one, and the credit industry is really kind of tough to understand. They do some different things, kind of almost counter to what you think they would be doing. Sometimes the more money you borrow, it will actually improve your credit, kind of depending on if you're keeping things in line, kind of like credit limits and stuff like that. But yeah, I'm not sure. I guess there's not much you can do there if that's the only thing kind of pulling it down, I guess. So I'm not sure.
That might be something, though, to be able to note and have a conversation with your lender about that,
Yeah.
to point out that in my credit, like, it's the different metrics are looking really good. The rating is fair because of the length of my credit history, not because of my performance during that 13 years. So I think those
Right.
conversations do make a difference. And
Yeah,
they're in this larger portfolio of the 5 C's that are being talked about.
right. Yep. And we actually have some flexibility on credit. Like every once in a while, we'll get an application where somebody just doesn't have credit. They don't have a credit card. They've never gotten a loan on anything. Their credit score is basically just not there. We can write a traditional loan. I say traditional loan. Every loan, I guess, that I'm kind of referring to as untraditional is through our ag score system. So that's anything under 750,000. Once we get above 750,000, we write what's called a traditional loan analysis, where it doesn't rely on your credit score so heavily. It's more based on a kind of worksheets that we put together, that we put all sorts of information into, a much more thorough analysis. This ag score system is going to rely on your credit, but it's also going to be a lot quicker for our loan team to process. So if you have, say a horrible credit score, kind of due to, something kind of, maybe that was kind of out of your control, or you just don't have one, we do have the ability to run smaller loans through a traditional analysis. Unfortunately, they do take, a fair amount of time, and things really have to look pretty good in order to do it that way, because if we're going to run it through our traditional analysis, then we have to, I guess it's just a little more complex of a process. But that being said, we
Right.
do have some flexibility on the credit score stuff.
And and we saw in your previous slide that you had a link for a credit agency. Is that this annual credit report? Is that the one that you recommend through Northwest Farm Credit?
I'm not sure, honestly, what Jessica had that link in there. I'm not sure. I think that's probably more. I'm not sure if anyone's clicked on it or not yet. I would figure that's more information. Maybe it will pull your credit. That's not who we use. I know that. But most of these credit reports will be within 15 or 20 points of each other. So whatever this is, will give you a ballpark. If it's an actual credit reporting tool. Like I say, Jessica had that in there. I apologize. I'm not sure if that will actually pull your credit or not. We use boy, I can't think of it off the top of my head right now, but we do not use this. I'm not sure. I wouldn't say annual credit report is probably the name of the company that's pulling it, but I think we use Experian. I want to say is who we're using.
Okay.
But yeah.
Okay, great. That's when the ones that the annual credit report lets you pull a free report once a year from the
Oh, okay.
above three agencies: Experian, Equifax, and TransUnion.
Okay. Very cool. So yeah, that's probably a great tool. A lot of even your credit cards now will kind of give you a ballpark idea every time you log on there. And it seems like those are fairly accurate. But again, sometimes we'll have customers, we'll pull their credit and it'll show, it doesn't look the best. And a customer will say, well, here it shows I'm 670, where, our Experian, or we have a couple that we use. TransUnion is one that we'll use too. Will show a little different. And so I don't know. I mean, it's just one of those things that will kind of vary, I guess, depending on what system we're using. So yeah, any more questions on credit scores?
Not right now.
Perfect.
Thanks.
So capital, the next C, what you own versus what you owe. So capital is basically referring to your balance sheet, which your balance sheet is a snapshot in time of your financial position. There's a lot of different ratios that we look at in a capital position, but I guess the biggest ones that I'll probably highlight here is your debt to asset ratio. We really like to see this, 65, really, that Jessica had that in there. That might be the AgVision requirement, but 65 is really getting up there. We really like to see that around 30% in a production ag type entity. It is where we like to see it. Don't get me wrong. We have them up there in the 50, 55 range, but that's considered a higher risk type of operation. An AgVision customer, we're going to be more flexible with. But yeah, you're definitely going to want to shoot for under 65% on that. Working capital, which is basically your liquidity position. This is basically telling us how liquid, I guess, your asset position would be. So it takes your current assets minus your current liabilities equals your working capital. So this number must be positive. This is basically just looking in the next year, your your incoming expenses versus your I guess I shouldn't say expenses, kind of your incoming principal and interest payments versus your current asset position. So we like to see a year, a year worth of kind of, I like to say flexibility or room for error. If you have a bad year, and kind of, if you don't make any money or you don't make enough money to service all your debts, this is the number that you're basically pulling from. So if you, I'm not sure if that makes sense the way I'm explaining it, but if you have a principal and interest payment, you got to make that payment. And if you didn't come up with the revenues to cover that within the year, you got to pull that from your liquidity position, basically from your balance sheet, which is not sustainable. So if you're showing that position is positive, that's just saying that you are not in a sustainable liquidity position. You're losing money. The way things are right now, you'll be losing money every year. So this is also your funds, your excess funds for down payment or expansion. If your liquidity position, if your working capital position is at zero right now, you don't have room for a down payment, or you don't have room to expand, because you're already running out of liquidity for what we'd like to see, currently. So if you pick up any more ground or any more expenses for your operation, you're going to be upside down. So that is a huge thing that we're looking at all the time. That's probably the first thing that I look at when I pick up a balance sheet. But yeah, just a super easy calculation. And honestly, a lot of just wage earners, their liquidity position is not very strong, because they're expecting a paycheck, a fairly sustainable paycheck month to month. So they don't have to worry about, crop failing, or, all they got to worry about is, I guess, losing their job. And so we're an ag entity. We're going to want to see a lot more room for error, just because there's a lot more risk in it than a wage earner.
So we have a question, is if you have a contingent sale, can you have a contingent sale for a ranch or farm? Meaning, can you leverage the sale of your current house into the equation for purchasing your ranch?
Yes. So you're basically taking your current house or ranch, and you're using the equity in that for a down payment. Is that?
Yes.
Okay. Yes, you can do that. You can do that. We would basically, what happens there, we see a lot, because very rarely does anyone just have, a $200,000 down payment sitting around. A lot of time we're pulling equity from another asset that they've either paid down. So yes, we can do that, and I'll kind of go into that in a couple slides. That kind of goes into our collateral valuation, would probably be where that fits the best.
Okay, great. Thank you.
So capacity, this one's fairly straightforward. This is basically just going to be your repayment for the loan. Will you have enough revenue from your ag entity and your off-farm income to repay your principal and interest on this loan and all your other loans. That's another thing some people forget. We have to take into consideration any other debts you already owe. We can't just show, yeah, he or she's got enough to take care of our payments. We got to be able to show you got to, have a bottom line after all your principal and interest payments. This is where we kind of already talked about your cash flow budget. We'll gather your tax returns, and we'll also make a budget and projection for your income expenses after your purchase. So that one's fairly straightforward. But yeah, a big one that, we'll spend a fair amount of time on this one, but it's a fairly simple concept, I guess.
So we have a question, and this relates to the question I emailed you about related to net worth percent. So on the balance sheet, you can get your net worth by looking at your assets minus your liabilities. And if you are, so I know that you used like debt to asset ratio.
Yeah.
And so that's the particular percentage that you're looking at.
Right. So yeah, so that figure is basically, so what was the question again? Sorry.
If you have a target net worth percent, or if you consider that in the loan package. So
yeah, so your debt to asset ratio would be kind of it would kind of be, so your net worth is your net number. So your debt to asset ratio is basically, what percent of your balance sheet is still owed on. But your net worth really should be a net number. We're subtracting the liabilities out of your net worth. So if that makes any sense.
Yes, so you're looking at net worth and debt to asset ratio.
Yep.
Okay.
So yeah, so there is another figure that is basically it's basically, I don't know what the term for it is. I rarely look at it. It's kind of I don't know what you would call it, but it's basically your net worth without taking out your liabilities. So your potential net worth, or your equity. I mean, it's not really your equity, because you still have to make payments on those places, but there is a figure out there where we don't take out the we're not looking at a net number. We're almost looking at more of a gross number. But that's something that I don't really deal with. That might be more of a mortgage lender might look at those, but that's not something I guess we would look at.
Okay, thank you.
So yeah, so next would be collateral. This is basically, just our security in the loan. So I guess kind of to start, our asset, the life of the asset needs to value the life of the loan. So if you're purchasing real estate, really the only thing that we can take as collateral is real estate. I guess a home, we can take a home too, because the useful life of a house is similar to the loan term. We can't take equipment as a collateral on a real estate loan, because in 30 years that tractor is going to be shot, or that pickup's going to be, it's not going to be worth what we have it valued as when we started the loan. And you probably still won't have it. You'll probably have traded something off. So we don't, basically we match the useful life of the asset with the term of the loan. So if we're doing an operating line, we'll take crops, equipment, because that's a year term, or a 3-year term. So we can be comfortable with taking, those assets for that amount of time, because they shouldn't be fully appreciated by then. But So what else on collateral? Advance rate. This is kind of goes back into that question: can we take a home for collateral? To kind of to substitute for a down payment, basically your equity in the loan. So basically, how we're going to look at all this stuff is we're going to look at collateral that is eligible to be taken for a certain type of loan. If you want to put up your house and piece of property, we're going to do an appraisal on your house, and we're going to do an appraisal on that piece of property. And if you can have enough equity in those things, in your home and that piece of property, where a 70% loan to value, so we'll take the appraisal number, what the appraisals come back at. So if it's 100,000, then we'll take 70%, which is our loan to appraised value. So we can only loan 70,000 on $100,000 worth of collateral, if that makes sense. So a lot of times people will come and say, I want to buy a piece of ground for 100,000. So then we'll say, you need to come up with 30,000 down, or provide another piece of collateral that has a 70%. Basically, we can get 30,000 of equity from another piece of collateral, if that makes sense. I suppose there'll probably be some questions on that. I'm not sure, but.
So we have a question, and the question is, so that's why we need 35% down.
So 30% down, correct?
30% down.
That's exactly right. Yep. So you need either 30% down or 30% equity in something else. That value in something else.
Okay, that makes sense.
I guess what I'm saying is
something else with the life of the loan, essentially.
Yeah.
Asset match asset.
So yep. So the asset would have to match. The asset would have to be eligible. It'd have to be the same useful life as what the loan term is, and then we would need to make up that value somehow. So either with cash or with equity from another asset. So yeah, any more questions on collateral? This is kind of a one that people are always trying to, I guess, figure out. But
not at this time.
Perfect. So conditions. This is the last C. This is basically how we're going to structure the loan. Term would be the length of the loan. Rate is basically your interest rate. There's a few different forms of that. A fixed rate is going to be fixed for the life of the loan. It won't change. For the whole term, it will not change. Variable will kind of follow the markets up and down. So it's going to be changing. I don't know if they change once a month. A variable rate would. There's a lot more risk in a variable rate than a fixed rate. If you have a variable rate and rates go sky high, your rate's going to go sky high. But if you have a fixed rate, as soon as we fix it, when we write you the loan, it's never going to change. So if rates go sky high, doesn't matter. Your rate's already fixed. And then combination. Very rarely will we do something like that. Sometimes we'll have a variable rate for the first 10 years and then fix it, for the remaining term of the loan. There's really no reason to do that unless there's something going on with the markets where, I guess you could say right now would it be a decent time to do it, because variable rates are just dirt cheap right now. So you could have a variable rate product for the first year or two of the loan and then fix it for the remainder of the loan, and try to save a few bucks that way. But generally we're not doing that kind of stuff just because it's not worth the time usually, and the markets just don't allow it. So repayment schedule, we're gonna base your repayment schedule on your revenue cycles. So if you're only selling wheat once a year, or if you're only selling calves in the spring, then we're just going to make your annual payment probably a month after when you usually sell, or 2 months to give you a little time to market. Where if you're a dairyman and you sell milk every month, you know, we're probably going to make it a monthly payment because your revenue is coming in every month, and there's no reason to make an annual payment, you know, if you have a revenue cycle every month. So that's kind of that. Liable parties, you know, that's basically your borrowers, co-signers, basically anyone that's going to be liable on the loan if the primary borrower can't repay it. Covenants, you know, on real estate purchases, there's rarely covenants. Maybe life insurance, I guess, but I don't know if I've ever had a covenant for life insurance on a loan. But basically, covenants to mitigate our risk. On operating lines, we'll see them a lot. Covenants can also be to kind of help a customer out. You know, where if we see a customer's, you know, really having a hard time limit their equipment purchases every year, they're buying new stuff that they probably really don't need, we might put a covenant on there that says only $100,000 can be spent on equipment purchases during this, you know, loan term, to kind of, you know, limit, I guess, you know, for them and for us, I guess, their ability to do that. So yeah, so if there are weaknesses in any of the other C's, conditions is where kind of we mitigate our risk there. So conditions is an important one. This is totally on our side. It seems like it's not something that you guys really would have to worry about. You know, this is something that we work through, I guess, after we've looked at the other 4 C's, and kind of, this is kind of where we balance everything out, I guess. So here's just a few things that I put together that these are just going to be my first questions, I guess, when somebody calls. I guess I shouldn't say when somebody calls. I'm not going to ask their debt to asset ratio over the phone, but when somebody walks in the door with a balance sheet, this is what we're looking at. You know, your debt to asset ratio is, you know, where's it at? Where's it line up? In each industry, all these metrics are a little bit different. These are taken off the AgVision procedure, but they vary slightly depending on what industry you're working in. Current ratio, so that's basically your liquidity position. Current assets divided by current liabilities. That's basically, you know, it's an easy one to calculate, but that's very similar to your working capital. It's just another way of looking at it. Working capital, I would encourage everyone to calculate that every first of the year and see, you know, where you stack up to last year. You know, have things gotten better? Have things gotten worse, and why? You know, working capital as a percentage of farm operating expense. That's a really good one. It just kind of tells us how much, you know, that I guess necessarily wouldn't be for a real estate purchase, but if we're doing your operating line as well, or if we're looking at just even if we're not doing your operating line, if you have an operating line elsewhere, we're going to look at that and see that's going to tell us what skin do you have in the game? You know, what percentage of your operating line is borrowed, or is you know, being financed, is what those metrics are going to tell us. Profitability and sustainable margins, you know, we kind of went over that before, but we got to show, you know, every once in a while we'll see, you know, we can show sustainable margins for the first couple of years. Maybe they have a accounts receivable from selling an entity or something, but we got to be able to show sustainable margins for the life of the loan. And we do have to show, we probably want to show, you know, I want to say a 25% margin is what we're looking for. That's not necessarily a requirement, but that, we can't just show to the dollar, this is going to work, after we make all of our principal and interest payments and all of our expenses are paid for and the family living and all that stuff. We do want to see a little margin in there still for, room for error on market cycles and stuff like that. And capital requirements, it's either capital or equity from something else. This is one that probably kills 80% of the deals that that we work with. It's a tough one to overcome, I guess. You really have to be working on it for quite a while to be ready to make a big real estate purchase.
So what does L stand for and what does AV stand for again?
So I had that in there earlier. So it stands for loan to appraised value. And I did have it in there, I noticed, as just loan to value earlier. I didn't have appraised value, but the actual acronym is loan to appraised value, because, I did kind of overhear what you guys were talking about when I first jumped on. These properties are kind of getting up there in value sometimes just because it's a nice area to live. They're more focusing on kind of I guess investors or people moving in for a vacation home. So some of these properties can be I guess a little bit overvalued. So we do have to go off of appraised value.
Okay, that makes sense.
How are we doing
Yeah.
on time? Am I?
You're a little bit over. Yeah.
I think we're about done here. So.
Okay.
Just be ready, have an idea on those benchmarks, business plan. It's surprising how many people call and have no idea how much I guess it's not super surprising, but it's always just, it's just great to have a good idea on a loan amount. It just sounds a lot better when somebody calls, and says, I'm not really sure how much I need. It's just kind of I don't want to say it's a red flag, but it's harder to, be confident in. Same deal, down payment, capital requirements.
We have a question that's related to that slide. And so the general question is that all of the participants in this short course don't have a current farm or ranch. Well,
yeah.
Actually, a couple are, at least one person does have a farm or ranch. But so how does a lender look at our current cash flow and balance sheets in combination with other documents like a business plan to see our vision for the farm ranch, for how drastically all the numbers will change once we take the plunge? So essentially, if you don't have, a production history,
Yep.
how are you looking at the projections based on the business plan and some of those, the potential in terms of that income statement?
Mm-hmm.
What are you looking at to make that determination?
So I guess we can talk about both, but so for an income statement, it's fairly straightforward. We're just gonna take the earnings that you had last year. Is the off farm income still going to be there? Okay, we'll have that on there. And then what expenses do you project having with this ranch? And what additional revenues will you have? And we're just going to create basically a projected balance sheet or a projected tax return for what we think next year is going to look like. That's where I was saying before. It's always great when a customer can work with an industry expert on those things, because they've probably seen it before. They know what kind of expenses go into a startup operation, and what the barriers to entry are and stuff like that. So I guess that would be my answer on that, is we're just going to build that based on what we think the expenses will be. And then for the capital side, for the balance sheet, we're going to do the same thing. So we're going to say you have your working capital is X right now, and you're going to have to use, you have $100,000 in cash right now. Well, you're going to need to take 25,000 and put that into improvements for your property, right? So we knock that off, and we're just going to take your current balance sheet, and we're going to project what it will look like after we kind of move these numbers around to different parts of the balance sheets, and kind of see what it looks like, I guess. We call it post close. So does that help out a little bit?
Yeah, I think it does. Generally that's where we talked a couple times in the past classes about, when you're talking about experts, that there are enterprise budgets out there for different production systems, different enterprises, really
Here,
thinking through what are those variable costs and the fixed costs. And then when we just like earlier today talked about the land assessment, really understanding what you would need to do in infrastructure to be able to get going, and then thinking about that in terms of your business plan and your cash flow.
right. And so I guess another thing I will say there is that's your risk, right? That's going to be the hardest part of this whole thing, is those two things. If you can, if it was real easy to just sit down and say, all right, here we are, I'm going to buy this piece of ground, and I know this is going to work because here it is right here, and XYZ, and I can show it right here. We're going to make $50,000 next year. It's never that, if it was that easy, everyone would be doing it. So I guess don't get, you need to spend a fair amount of time on that stuff, but that's the hardest part of the whole deal. Basically you're taking a risk, and that's the tough part right there. So I guess don't get too caught up on that, but yeah, those are pretty challenging to put together, and they kind of mitigate your risk, but there's definitely still going to be some risk in the deal. So so just a few things to get started on. I mean, that you could start on right away is have accurate historical financials. Every first part of the year, fill out a balance sheet every year and see what it looks like year to date, year over year. Did we get better last year? Did we get worse? Why? What happened? What can we do differently next year to preserve some liquidity, or lower our debt to asset? Maybe we need to focus on paying down debts. Leases, you could pick up a lease on something and give it a try. Give whatever you're thinking about, just try it, for 5 years. That's going to look awesome when you come in, acquiring for a loan then, where it's, yeah, I have an existing cattle ranch, I've been doing it for 3 to 5 years, even 1 to 2, it's going to look a lot better than, not that it's going to look bad if you come in and say, hey, I want to buy ground and I want to start a ranch, but it's definitely going to be a lot easier to make a lending decision on, hey, I've been doing this. Here's my business plan. It's, we're right here and here's where we're going. It just kind of, I don't know. And then you don't have so much risk in it at the beginning, where if you go out and buy a piece of ground, you're kind of in it for the long haul, I guess. Anyhow, that one's fairly, I don't know. It's something to try, I guess, but right along, a lot of these guys, a lot of these producers are fairly willing to, show you what they're doing. Not necessarily ins and outs, but I wouldn't be one bit surprised if you had a neighbor that said, hey, would you mind me jumping in with you for a couple days and kind of seeing what your day-to-day looks like? It's just a good place to get started. And then talk to industry leaders. Yeah, so I think that's about it. So.
Okay, great. Well, thank you, Ben, for that really comprehensive overview. Do we have any last questions for Ben? As I noted in the chat, we do have the slide presentation in the classroom already. And see if there's any last questions. Okay, I think we're good. Thank you so much, Ben.
Thank you. Yeah, sorry I went a little overboard there, but I guess kind of got away from me. So.
Oh, well, we totally understand. That's great information. We really appreciate your being so thorough and providing that deep dive. And if you do find anything about matching with VA loans or a resource person that our
Yeah,
participants can talk to, if you can just send that on to me, if there's another relationship manager or somebody else that would be helpful to them, we would love to have that connection.
yeah, you bet. And if any of you guys think of any more questions, feel free to shoot me an email, and I can either do my best to answer them or point you in the direction of someone that probably could. So,
Well, that's great. Thank you so much for your time.
alrighty, thank you. Thanks for
Okay,
having me.
thank you.